So we are going to hop right into our programming with some key takeaways, and we're going to have an economic outlook. This is a fireside chat. It will be moderated by Bill Watts, our editor of Pro Farmer, with featured guests President Raphael Bostic from the Atlanta Federal Reserve Bank. We will look forward to hearing a bit of his outlook, also insights on ongoing trends, including around labor and inflation, but really getting at what the current economic outlook means for your farm and your bottom line. You will be able to ask questions. You will find a QR code that's on your tables. Please scan that with your phone. You can type in your questions, and those will go directly to Bill. Please join me in welcoming Bill Watts and President Raphael Bostic.
Good afternoon, everyone. I'm really thrilled to be kicking off this session with Atlanta Fed President Raphael Bostic. The Atlanta Fed District includes Alabama, Florida, Georgia, portions of Louisiana, Mississippi, and Tennessee, really the heart of southeastern agriculture. And we meet at a historic moment. Not only is Dr. Bostic just weeks away from his retirement, but the Fed is navigating a leadership transition following the nomination of Kevin Wash to be its next chair. So we have a lot to talk about. President Bostic, welcome.
Thank you. It's good to see you.
Thank you. So really eager to delve into what's been going on in the farm economy, but first thought maybe we could talk a little bit about what's been going on more broadly in terms of monetary policy in the Fed. So this leadership transition has been accompanied by intense debate about the independence of the Fed and what that means for policy making. Do you have any qualms that a Warsh-led Fed will be less independent? And also, why should the people in this room care about that question to begin with?
Well, first of all, good afternoon. It's good to see you all. Welcome to the 6th District. It's good to have this conference here in part of my district. You asked the question in two ways. I'll talk to the second one first. You know, the Federal Reserve is the U.S. central bank. We are charged with a dual mandate, stable prices, that's the inflation part, maximum employment is the other part. And our charge is actually to create a foundation so that the economy can proceed and grow in a predictable way. So that for families, for businesses, for farmers like yourselves, you can invest for the long haul with some confidence about where the economy will be when those investments come to fruition. In order to do that, it requires us really to have that longer term horizon in terms of thinking about where our impacts lie and how it plays out. And to have that kind of extended arc for our policy, we need to be able to be patient. And what I think all of you know is that many others have much shorter time horizons. They want decisions or policies that are going to help in the short run, but you also know that an investment for a 1-year horizon is not always the best investment if you're thinking on a 10-year horizon. And so we're in an environment where the independence of our institution allows us to think in that longer horizon and to be disjointed or separated from sort of the ebbs and flows of the world as it happens. And I don't have to tell you all, the world has been, a lot of ebbing and flowing has been going on recently. And so that's the important part. So for us to do our job well, having that arm's length and the ability to do things over a longer horizon and think over a longer horizon is quite important. Now you asked, do I have qualms? I will say I've been in this role for almost 10 years, and every central banker, every one of my colleagues that I've talked to, they take the job understanding what the task is. And we have collectively really tried to be as true to that as possible, and I don't think that is likely to change moving forward. The pressures are going to be what they are. I tell people Like, if you're going to take this job, you should get used to you should expect to be yelled at all the time. People are going to have their own views, and that's okay, and they should be free to tell us. We can take that on board, but ultimately we have to do what's true for our institution.
Now, speaking of patience, we saw the Fed decide last month to leave rates on hold after 3 consecutive cuts. I know you agreed with that decision, and you've indicated you wouldn't be in a hurry to resume cutting rates. Now, last week we did see some labor data that seemed maybe a little bit shaky. I know we're still waiting for the January jobs report, but are you still confident in the resilience of the labor market, or are we starting to see some cracks emerge?
Let me speak more generally about the U.S. economy. So this economy has continued to be resilient at the aggregate level at ways that I don't think many analysts had anticipated. There was a time I'd go around and give business talks, and the first question would always be, what are you doing with interest rates? The second question was always, when's the recession coming? And I don't get that question anymore. I think people have gotten their heads around the idea that this economy has continued to perform well at an aggregate level. Consumers have continued to be resilient, and that's a good thing. And my outlook is that that resilience that we've seen for much of 2025 will continue into 2026, might even get a bit stronger. And so we might actually see some of the tax benefits, some of the deregulation. Those things could actually spur the economy to do even more than what it did last year. And those are all positive things. That's one reason, but that extra strength actually puts upward pressure potentially on prices. And since our inflation is already too high, I want to make sure that it is back on track to our 2% target before we do dramatically more in terms of moving our policy to a more neutral stance. Now, you asked about the labor market. The labor market is producing fewer jobs in the U.S. on a monthly basis than it has historically. Historically, the break-even level has been somewhere like 120 to 150,000 jobs in a month. These last 6 months or so, we've been averaging somewhere between 30 and 60,000 jobs a month, which is far less. Now the question is, what do you make of that? And I think it's hard to know. Like, on one level, usually when you see job growth start to slow down, it's because there's been a drop in demand for product. When I go around, I talk to businesses, they don't tell me that they're worried about being able to sell the number of goods that they are producing. The demand has remained solid for the most part. And so that's one thing. A second thing that businesses tell me is there's so much uncertainty out there, political uncertainty, geopolitical uncertainty, policy uncertainty, that they've been largely reluctant to do anything too bold in terms of hiring, because they don't know what's going to happen. And until they have a strategy or a plan that they think can sustain, they don't want to get too far out ahead. And that's one reason why you might expect to see the number to be lower. And then there's a third category of issues in the labor market around the question of whether there are just fundamentally new things happening in terms of how production is happening, such that businesses can produce the same amount of product with fewer people. So you think about AI, for example, and those technologies. Businesses are experimenting with ways to have AI introduced into their production processes to allow productivity that doesn't require people. And so you may have heard reports about a lot of entry-level hiring has happened at a much lower pace than it has in previous years, and a lot of that is because the promise of AI has folks thinking, well, maybe I don't need to do those hires and I can get that same amount of productivity. That's a structural change. And if we want to make sure we do our policy right, we need to understand whether a number is a good number, a bad number, or an in-between number. And if you have structural changes, that's an evolution. That is actually a transformation that makes it hard to know that for sure. And so until you know, I want to, again, be cautious. I don't want to jump too boldly in any direction. I think it's prudent for us to wait and make sure we understand what these numbers actually represent in terms of the strength of the economy and the labor market. So for me, I do think that we're in the transitional period, and we have the luxury of being patient because the economy is so resilient. Let me say one other thing, because you mentioned the jobs report that's coming out late. The government shutdown actually prevented a lot of data from being produced, and it actually is going to make the numbers a bit choppier in the next several months. So the usual signals we would get from those are actually going to be weaker than they would be otherwise. And for me, that's even another reason why I think we want to be cautious, we want to be patient, and I think that'll be prudent.
Now, speaking of resilience, or maybe a lack of, the farm economy has been in the headlines a lot recently, usually not for positive reasons. And last week we saw USDA predict a fourth straight year of falling net farm income, and that's even with an expected 45% jump in direct government payments. We also saw a letter was sent last week from a bunch of prominent former agricultural leaders to House lawmakers, warning that the dire state of the farm economy risked a, quote, widespread collapse of agriculture. And I'm just wondering, from where you sit, are we facing a national or regional farm crisis of some sort?
So we may want to turn this around and ask the folks in the audience this question. I would say this. I talk to a lot of farmers. We have an agriculture advisory council that we meet with on a quarterly basis or on a regular basis. And what they tell me is that it's hard out there right now for farmers. I think cattle is an exception. Those pricing has been strong there. But outside of that, there are real questions as to whether historical business models are going to be able to sustain in the challenging environment. We know that input prices for a host of products are up. We know that competition at a global level is up. We know that the tariffs have put tremendous pressure on the competitiveness of products, American products, overseas because of those dynamics. And we also know that many commodity prices haven't changed to offset these things. And so these are all incredibly challenging dynamics to wrestle with. And how we move forward is really an open question. So I do think there's a significant crisis here. And particularly, I get to talk to a lot of smaller family farms. And I worry about them especially because, the big operations, they are so large. Scale gives you a diversity of possible strategies. You can tap into different types of credit that can allow you to weather volatility a bit more readily. And we don't see that for a lot of the smaller folks. This is actually true even for just small businesses more generally. We do national surveys of small businesses, national surveys of businesses, and one thing that we've seen over 2025, starting in 2024, is a split in sentiment, where the big companies, the big firms, they were optimistic. They felt like they had strategies that could really get through whatever was going to come at them. And we saw a decidedly negative turn in the sentiment for small businesses that don't have those alternative approaches. So this is actually a more general thing.
Well, if we could maybe bring that back to monetary policy and monetary policy formulation. Agriculture is incredibly capital intensive. And when rates stay restrictive while commodity prices languish, how does that pain, I guess, figure into the policy-making equation? Does it just fall between the cracks of the dual mandate of full employment and stable prices, or
nothing falls between the cracks, right? So we don't let that happen. I would say this is a really complicated issue because when you think about the marketplace, you have two sides. You actually have the producer side, but also the consumer side. And one thing that we've heard from many families and households is that high prices are a problem. And if the prices stay high, then they're not going to buy a lot of goods. They're not going to buy a lot of product. And many of the products that you all are trying to sell are going to be trade-off products. Like we see many consumers, when I think about the US economy today, I talk about the aggregate, but what is also true is that there are very few people who live the average number. Right? You have a bunch of people who are doing really, really well, and then you have a bunch of other people who are kind of precarious, kind of paycheck to paycheck, week to week, just trying to get by. And what we've seen over the last 2 years or so is an increase in the share of the population that's in that second category, right? And so when I think about prices and our policy role on prices, if we get inflation back down to 2%, that precariousness eases in a way that allows everything else to start to flow. And right now, our inflation is in the upper twos. We're trying to get to 2. And I'll tell you, before the pandemic, we were at like 1.7, and people said the Fed is not doing their job. Right? So if 0.3 away is too far, 0.9, 0.8, 0.7 is too far, like way too far. So we've got to get that under control. If we get that under control, and the sooner we can do that, the better, then I think it will start to resolve a bunch of other issues because everybody will be able to look forward with optimism.
Yeah. I just wanted to delve into some recent data coming from the Fed, actually, on farm lending. We saw recently the fourth quarter national survey of terms of lending to farmers. And it showed that the average farm operating loan in 2025 was 30% larger than the previous year, and it was actually record size. So I'm just wondering, when you look at that, I mean, is that a sign of productive investment, or is that more a flag of some real pain in the sector?
I think it's probably more a sign of productive investment, but it's really just a small part of a larger story, in the sense that, being able to buy that equipment that's become more expensive allows you to keep doing the things that you're doing. But if commodity prices don't change enough, if the competition doesn't change enough, there's still going to be hardship. So I'm very heartened by that, and I talked to a bunch of lenders. They do feel like that market is loosening, is easing for them, and they're able to do more and have more activity. That's one cog of a large machine that needs to make sure that we need all of them to run. So I do think it's positive, but I think the folks who I'm talking to don't think that that's enough, and they really do want to see some significant changes in how some of these markets are functioning.
Yeah. Well, if I could just kind of follow up on that issue, because there was also, we saw the January Purdue Ag Sentiment Barometer, Farmer Sentiment, and every year they ask about operating loan size, and they found that 21% of farmers expect to have a larger operating loan this year, but they noted that of those 31% who are going to have a bigger loan, say it's because they're carrying over unpaid debt, and that's up from just 5% 3 years ago. So I'm wondering, is that some sort of an early warning sign for the banking sector or anywhere else, or how do you look at
So
that?
I'll say two things on this. So that is definitely a warning sign, because this is just for households. Like if you have a credit card, the more you carry on as opposed to paying off, that's a sign of some distress, and then that is true, that's there. It's interesting, when I talk to bankers, they're not telling me that they're super concerned about credit quality in the agricultural sector or any of the other ones. And so I will take this back and make sure that that we look under the hood more deeply on this. But today, the bankers that I talk to, and of all sizes, they all tell me that credit quality is quite strong. So even with that dynamic, I'm not hearing a lot of concern that this is like a turning point where we're nearing a cliff.
I see. Okay. And I'm just wondering now, I think, one thing that, maybe does give people maybe a little more confidence is, around the balance sheet, farmland prices have held up. Do you see that continuing, or given the economic backdrop in agriculture? Or?
So yeah, I've been kind of surprised that, in all of our surveys, in all of our conversations with business roundtables and the like, the sentiment is really that it's going to be more the business as usual, what we had last quarter and the quarter before, or what folks are expecting this quarter, the next quarter, and well into 2026. It's one of the reasons why I've been comfortable having an outlook that has the economy performing so strong in the aggregate, because I'm not hearing anyone really who thinks that things will be appreciably weaker. And as I said earlier, there are reasons why it'd be stronger. So I do think that what we're seeing now is likely to persist for a while moving forward.
Yeah. Now, at the end of the month, we're going to see the payments from the Farmer Bridge Assistance Program roll out, and I'm just wondering, I guess, how you view that from the Fed perspective. Is that a safety valve, or is that another inflationary hurdle in a way?
So I probably wouldn't call it an inflationary hurdle in the sense that it is trying to keep people whole and keep farmers whole. So I don't see this as injecting extra stimulus. It's the type of support that allows activity to be comparable to what it was in the past, right? And so I actually see it that way, and I think it's very much like some of the payments that happened during the pandemic to try to keep families able to still buy food and do those sorts of things. Those things just prevented the bottom from falling out, as opposed to catapult things moving forward. And if you think about the inflation that happened in the wake of the pandemic, much of that was caused by demand of higher income households who were not on the edge of precariousness, who weren't feeling the kind of deep stresses that are the drivers for a lot of the support. So I'm not worried about that as like being an extra lever to contribute to inflation.
Great. So I'm going to turn to some questions from the audience. And actually a couple different questions here pertaining to debt and the deficit. So that's one question you're asked, at what point does the bond market penalize us for our increasing federal deficit, and how should we respond?
Well, usually I have to say you have to ask the bond market themselves. Look, what is true, and Chair Powell has said this in testimony many times. The trajectory of our debt and our deficit is not sustainable. Like, this will come to roost at some point if it is not addressed. And when that will happen, it's really hard to say. It's so interesting. It's not exactly an analog, but so you think about in financial markets, they get very volatile, and a seemingly small thing can trigger a pretty large response. You think about what's happened in sort of the equity market, its volatility recently with the AI, what people said was a response to AI. To me, it was strange because the disruptive potential of AI has been known for a long time. So what was it that in that moment that made it material for valuation? It's hard to know. So I think about the bond market in much the same way, and it will probably be a combination of things all happening at once, where there's a risk that people might lose confidence in the U.S.'s ability to manage its finances at sort of the aggregate level. And hopefully, we will take some steps through our legislation to address it, and then maybe we will not have to talk about this anymore. But we're not there today. I do understand that. So.
Okay, we have another question about specialty crops, which the district has many different ones out there. So but it says specialty crop producers are declining in number in the U.S. due to pressure on imports by international marketing companies sourcing from countries with lower costs of production. Do you see this continuing, and is there enough being done to keep U.S. specialty crop producers sustainable?
Well, I do think it's likely to continue. We would probably need there to be shifts in policy and and how these markets are managed. It's interesting. As we become more global, these kind of forces and challenges have increased significantly. And you've seen specialization occur where production happens at its lowest cost location. In the last 5 years or so, we've actually seen a retrenchment away from globalization in ways where you might conceivably start to see that ruthless pursuit of lowest cost be pulled back from. I think about the supply chain disruptions that we saw in the early part of the pandemic. Much of that became so acute because producers only had like the one supplier of each of their inputs, right? They didn't have diversification that allowed them to be able to weather that kind of volatility. To the extent those things start to become more common, as in addition to the reality that large economies are decoupling, we're starting to see that. You might find niches and spaces for these specialties to once again reemerge, but that'll be on a case-to-case basis. I don't think it's the type of thing that you should just generically assume that all of them will be able to manage.
Sort of tying back to the earlier question about the deficit, obviously the US dollar, very important to agricultural exports, and also on the other side of the coin is what it means for input prices. So I'm just wondering how you view the dollar as a factor in the economic picture for agriculture, and whether you see a structural shift towards a weaker dollar.
So that's a really hard question. The dollar's strength and its valuation is driven by a number of things. One is that on some level we are viewed as the safe place. So we get a funding premium because anytime there's turbulence, folks have historically wanted to move their money into dollars because it retained its value more than other currencies. I think we've started to see a bit of a rippling where that confidence is perhaps being questioned in places that it had not been questioned before. And that has real implications for all of these dynamics and the strengths of these currencies. When I was a professor at University of Southern California, and I would ask people, like, where would you want to invest your money? If I told you could invest it anywhere in the world, where would you do it? And the answer was always the United States because it had a clear rule of law, property rights were sacrosanct, and there was confidence that it was reliable. And when I was in Europe last summer, and people were asking, like, can we still trust? Like, what should we know, and how should we think about where things are? Those are the sorts of things that will create rippling in the valuation of the dollar above and beyond what happens in specific markets. And we will have to, hopefully we don't lose that. I think it's been good for the US to be the fiat currency for the globe. And that's where we'll go.
So as we come to the end of time here, I'm just wondering, as you look back on your tenure at the Atlanta Fed and think about the future, I mean, what advice would you give your successor, particularly when it comes to dealing with the agricultural economy?
So one thing that I've really appreciated in my time in this role is talking to people and the transparency that business leaders, that farmers, and others have had. So for me, I'll tell my successor, get out in the fields, go visit folks, find out how business actually happens, find out the challenges and the concerns that regular people have, both on the consumption side as well as on the production side, and then take that back to the building and have it inform your policy. Because there's a lot of nuance, there's a lot of detail, and as I said, you have an aggregate big top line number that nobody is living, right? And so understand all the different ways they're living and be thoughtful about how our policy is going to affect all of those things. I feel like I've been so much enriched by the generosity of farmers and business leaders all over the country just to tell us what's real, so that, at least I'll say for the Atlanta Fed, no one can say we're in an ivory tower. No one can say we're disjointed or out of touch with what's going on. And I want to make sure that stays that way forever.
Okay, great. Well, I want to thank you for joining us, especially as you're coming to the end of your tenure, and we thank you for your candor and your service to the Southeast. And please join me in thanking Dr. Bostic.